Hey, Paul Morrow again, Smart Financial. Here we are in March 2025, and I have to say, this is another edition of Portfolio Protection and Tariff Turmoil, right? We are having Trump tariff turmoil. We talked about this 2 months ago. Everybody in the financial industry has been talking about it. We're predicting, we have estimations and projections, and guess what? It's here. The average 401k in America is about $408,000. That's the average. Certainly, there's people with a lot less and folks with a lot more. But let's just use averages to talk about the impact of this Trump tariff turmoil on you. Right now, we're having a market drop that is specifically related to this new administration, right? It's Trump tariff turmoil. Now, how did you get to have a $400,000 401k? If you're an average American, you're a hardworking saver, you're putting money in your 401k, let me remind you that 5 years ago, just 5 years ago, if you had 210,000, it's now 408,000 because the S&P 500, which is largely the biggest investment in 401ks in America, the SPY, the S&P 500 ETF, is the largest ETF in America. Everybody buys it. Everybody recommends it. I do too, especially if you're a young person. You can buy a low-cost index fund and own a little piece of the top 500 companies in America. We won't get into that too much in detail, except to say that if you were in the S&P 500 index 5 years ago, your portfolio went up with the market 95%. So the last administration, you can beat them up for all the reasons you want to beat them up. But as far as the U.S. stock market is concerned, for those of us in the financial industry, we're all very happy. We all made a lot of money for our clients. We made a lot of money for ourselves. 100% in 5 years is a good number. 95.6% to be exact. Okay? So your portfolio went from 201,000 to 408. You find yourself in January of 2025 with a $400,000 401k. All right. That's a good, healthy start to a retirement, right? Especially if you're a midlifer and you're not on your precipice of retirement, but you're doing your hardworking saving thing. And then you wake up to all the Trump tariff turmoil and you're listening and you're watching everybody and you're not quite sure how it's going to affect you. I will tell you right now, today, as I'm talking to you, we say the market has cycles. Every 7 or 8 years, the market's up, the market's down. And no one really knows what it takes to tip a market over from the high spot. I did a video a while ago at the market being at all-time record highs. I actually did it in January after the numbers came in for last December. And there were some suggestions in there about those of us that are older, what we're called boomers, right? About taking some profits off the table. Might be a good idea to not be too greedy and take some money. Okay. Since then, the S&P 500 has gone down 2.5%. What does that really mean? That means to the average American with a 401k, you just paid about $10,000, $11,000. That means your portfolio went from 408 down to 398 or whatever, right? You just paid $10,000 for all this turmoil, right? Out of your 401k plan. Now, I'm not suggesting that you bail out. I'm not suggesting that you stop putting money in. But let me put it in perspective. If you are a young person, that is what we call millennials. Actually, the subject of my third book coming out, Smart Financial Wealth Building, right? If you're a millennial, I'd buy in because I'm a big believer that U.S. companies will prosper over time. And if you've still got 25 years, I believe what every other person in the financial industry believes, I would not bet against American companies. So I would buy in. It's a good time to put in extra. It's a good time to buy some more, right? Especially if you're just an indexer and you're buying into the Dow, the NASDAQ, the S&P. I would actually put extra money in. This is a market dip. By the way, if it goes down 10%, that's a correction. If it goes down 20%, they call it a recession. I'm expecting it to go down 10%. We're down 2.5% now. The projections for this Trump tariff turmoil are that we're probably locked in for a 10% reduction. If you're a young person, I would take advantage of this. It's like going to the supermarket and all the food that you like is 10% off. Would you buy an extra steak or two? I think you would. The market's down, put some extra in. Now, if you're a midlifer, if you're the subject of my second book called Smart Financial Lifestyle, which is just out, right? If you're not 25 years to go to retirement, but you're in that midlife stage, you should be an asset allocator. An asset allocator is a person that is not 100% in the S&P 500 index. An asset allocator is a person who has some money in active investments, some money in passive investments, and some money in alternatives. Alternatives can include portfolio protection insurance. It's time, if you're a midlifer, to make sure that you and your advisors have put in place portfolio protection insurance. Now, there's a bunch of ways to buy it. You can do it yourself. You could actually research how you buy puts and calls and options and straddles, and you could do all that stuff. We have a lot of brilliant people out there, and I don't want to take it away from anybody who likes to do puts and calls and options and straddles on their own. However, the vast percentage of people in America are too busy to do that, and it's very easy to lose money when you buy portfolio protection devices. It's probably much wiser for you to do that with your financial advisor who protects that portion of your portfolio. When you're doing portfolio protection management, there's really three ways to handle it. Yes, you can put half your portfolio into fixed income, and that makes you only 50% exposed to the loss because half your portfolio is locked in and it's safe. And you know, I advocate if you're going to put half your money into a fixed and either insured type of product, why would you be paying any money management on that? It doesn't make any sense, right? So that alone saves half your fees. So you have extra fees to pay to your equity advisors, the people that are running your equity portfolio, that are buying puts and calls and options and straddles, or using one of the great money managers that has that algorithm built in. You can pay them an extra fee for that, right? So pay the extra fee. We have always said in the money management business that risk is free. Protection costs money, right? If you want to be protected, whether your house burns down, your car gets in a wreck, or your portfolio gets in a wreck, pay the protection fee. Otherwise, learn to live with the risk, right? So you have a choice, right? You can ignore it if you're a young person, right? These are the three ways to handle this portfolio volatility. By the way, it's not going to last forever. The market goes down, these repetitive cycles are 7 or 8 years. It's going to come back. I'm very bullish about the future, but right now, if you're a young person, I'd be in the ignore it camp. In fact, I'd be in the jump on it and buy some more camp. If you're a midlifer, I would definitely be in the manage it camp. I would be adding portfolio protection devices to your equity portfolio, and I would be a smart allocator, all right? And if you are fully retired, let's say you're over 70, and you're very conservative, and you have enough money, and you can live on the 5 or 6% returns, then you can basically avoid it entirely and buy the products that give you 100% principal protection and some market upside that's tied to some index. I like those products. I like them for our retirees. I especially like them because you can lock in the new ROI for retirees. That's reliability of income, not return on investment, but the new ROI, reliability of income. And let me tell you what I mean. In this kind of a marketplace, let's just pick on one company in particular, McDonald's. Wonderful company, right? I know that my son, in a pinch, driving, traveling, he's had a lot of McDonald's burgers over the years, right? And so we've contributed to the value of that stock. It's been a profitable company for years and has about a 4% dividend. So here's an example of simple math. If you have a stock and it's paying a 4% dividend, that's a good dividend paying stock. And if the stock drops in half, then all of a sudden your dividend yield is 8%, right? But dividends aren't guaranteed. So if you're living on dividend income, that's great. If you don't care about your portfolio fluctuation and the company is strong and it can keep the dividend, right? It just means your dividend yield goes up, right? And you can ignore that. However, if you're a conservative older person and you want to have 5 or 6% guaranteed income streams with no principal fluctuation, that means no stock value fluctuation, you need to convert to a different type of product in retirement. If you don't have a financial advisor who is actually competent and experienced in that area of portfolio protection products, it might be time to interview a new advisor. You know that you can contact us for questions through the Smart Financial Lifestyle website. You can hit us up on Facebook, subscribe to this channel, follow us, even attend some of our public meetings we're having in the East Coast this year, from Portsmouth, New Hampshire down to Providence, Rhode Island. Jump on one of our webinars. Feel free to reach out to us. If you need a reference to some of the great advisors that we know that are associated with us over the last 50 years, we'll be happy to do that. I'm Paul Morrow at keeping up to date on your portfolio protection at this time in history is just the art of being smart. I'll see you again next time on Smart Financial.